Why would you invest in stocks? Everyone knows how volatile the stock market is, so why do people take the risk instead of growing their money in a savings account? Here's the thing, when you look at the annual rates of return for different investment options over the long term, around 20 to 30 years, there's no denying the growth potential of stocks. Let's say you had $100 in 1970. If you would have kept that in your savings account until 2023, it would now be worth $956. This is because bank savings accounts pay around 3% interest per year. However, if you would have invested that same $100 in the stock market in 1970 instead, you would now have just over $22,000 because the stock market has an average return of 10%. So, based on historical returns, the US stock market has provided the highest returns compared to other investments if you plan to stay invested for the long term. Let's look at a few more examples. Maggie and Jesse, who had been friends since childhood, both started their first full-time jobs at 20 in 2013. With a shared goal of owning their own homes by 30, they committed to saving $250 per month to make their dream a reality. Where Jesse invested her money in stocks, Maggie decided to keep her money in a savings account, paying 3% interest instead. 10 years later, by 2023, Jesse's portfolio had grown to $52,210, while Maggie's account had only grown to $34,935. Thanks to her investments, Jessie could afford the 20% down payment on a $250,000 starter home by age 30. Before Maggie can achieve her goal, she'll need to start investing her money to increase her wealth over time. In another example, Ryan and Eric, who were just 15 years old in 1970, made a pact to become millionaires by the time they retired. Fellow classmate Tia overheard their discussion and decided to do the same. Ryan started contributing $167 per month, or $2,000 per year, into his brokerage account as soon as he got his first job. He was able to grow his net worth to over $28,000 by the time he was 25. He couldn't wait to tell Eric and find out how he was doing with his investments. While catching up at a local diner, Ryan found out Eric hadn't been investing at all. He spent all the money he earned. Ryan suddenly felt like he could get away with spending money on other things for a while. After finding out how well Ryan was doing, Eric decided it was time to start focusing on his financial goal of retiring a millionaire. Then, just like Ryan, Eric contributed $2,000 per year into his brokerage account for the next 40 years. Eric invested in the same index fund that Ryan had bought too. At their 50th high school reunion, Eric was proud to show off his portfolio returns to Ryan. He had done really well over the last few decades and had reached his goal. Ryan was just as surprised to see the results. Ryan's early start and consistent contributions gave him a head start. Although he stopped adding to his portfolio when he was 25, his initial investments continued to grow, resulting in a retirement fund of $2.9 million. Eric, who started investing later, may have invested more money over a longer period, but his returns were lower, totaling $1.5 million. Either way, both Ryan and Eric achieved their goal. Tia eventually joined their conversation. She thanked them for inspiring her early start to saving and investing her money, becoming a millionaire by the time she retired too. Tia had been a teacher with a starting salary of $9,200. She knew she couldn't save that much, but she always saved 10% of her salary. Whenever she got a raise, the amount she saved increased too. When she retired in 2022, she was earning $65,800 per year. According to 75% of the millionaires in a national study of millionaires, regular, consistent investing over a long period of time leads to success. Also, 1/3 of millionaires surveyed said they never made over $100,000 at any time in their working life. Many of them were teachers or accountants. So it's not about how much money you make, it's about what you do with it. The earlier you start and the more consistently you contribute, the better off future you will be. To really see some incredible returns, you can invest like Tia, who not only started young, but she also increased her contributions every year as her salary increased. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it.